Have you ever looked past the polished lobby of a bank and really wondered how these massive places actually tick, how they make their money, how we can tell if they're actually healthy, and what's next for them, especially looking ahead to 2025?
Hmm.
Well, today we're doing a deep dive right into the heart of the banking sector, our mission, to give you a clear, practical handle on how banks operate, from profit basics to valuation and where things seem to be heading. Think of it as your essential guide to really understanding this cornerstone of the economy.
Absolutely. And analyzing banks, it's a unique beast. Very different from looking at other kinds of companies. Their balance sheets, the regulations, it all requires a specific lens.
Right.
So our goal today is to give you that framework, that toolkit, so you can get a real sense of their fundamental health and their actual value.
Okay, let's unpack this then.
Yeah.
At its core, a bank's product isn't something physical.
Yeah.
It's money itself.
Mhm.
So their profitability basically comes from managing the gap between what they pay for money and what they earn lending it out.
That's the essence of it, financial intermediation.
Exactly. They borrow cheap, think our checking accounts, and lend higher. That spread, the interest rate spread, that's the foundation. But it has to cover everything, right? Operations, potential bad loans.
Precisely. And that brings us to how we actually measure this core lending profitability. The key metric, you'll hear it all the time, is the net interest margin, IN.
NM.
Simply put, INM is the net interest income, what they earn, minus what they pay in interest, shown as a percentage of their interest-earning assets. It's like their profit margin on the money itself.
Got it. So a healthy, stable NM means things are running smoothly.
Generally, yes. A positive, stable NIM is a really strong indicator of efficient operations.
So, okay, if NIM is so critical, how much does the wider economy, things like central bank interest rates, push it around? It feels like it can't be as simple as rates go up, banks make more money. Is
Yeah,
it?
that's a really good question. And you're right, it's definitely more nuanced than that. Generally, a rising rate environment can help banks. Well, their assets, like variable rate loans, often reprice upwards faster than their liabilities, like our deposits. So that gap can widen, boosting NIM. A steepening yield curve helps too, borrowing short-term cheaper, lending long-term at higher rates.
Okay, that makes sense. But there's a catch.
There is. If rates go too high, it can choke off loan demand, people stop borrowing, and defaults might rise, which means banks have to set aside more money for loan losses. Those provisions eat into profit.
Right. And what about when rates fall?
Falling rates tend to squeeze NIMs. The yields on their assets drop, but they can only lower deposit rates so much. There's that zero lower bound.
Can't really pay negative interest easily on checking account.
Exactly. But the upside of lower rates is that it's cheaper for borrowers to service their debt. So default risks usually fall, and those loan loss provisions can shrink. It's this constant trade-off, chasing higher NIM versus managing credit risk.
That balance seems key. And it highlights how relying only on interest income could be, well, pretty cyclical. Our sources mention banks increasingly focus on something called non-interest income. What's that about?
Right. Non-interest income is basically revenue from everything else besides lending and investing. Think fees for services. It's become strategically vital as a buffer, especially when interest rates are low or bouncing around. It helps smooth out those earnings bumps.
But it's significant.
Very significant. It might surprise you, but non-interest income consistently makes up around 35% of total income for U.S. banks. That was roughly $295 billion in 2024. It's a huge part of the picture now.
Wow, okay, so are all these fees created equal? Are they all stable?
Ah, good point. No, they're not. You've really got two main buckets. There are the stable, predictable fee streams, and then the more volatile income tied to capital markets.
Okay, like what?
Stable fees. Think monthly account charges, overdraft fees, NSF fees, annual credit card fees, and really importantly, fees from wealth management, managing client assets, and trust services. Those tend to be pretty steady, less tied to the economic cycle.
And the other bucket, the volatile one.
That's things like revenue from sales and trading activities, fees from underwriting, helping companies issue stocks or bonds, and advising on mergers and acquisitions, M&A. That income can swing wildly depending on how the economy and markets are doing.
So understanding that mix is crucial then.
Absolutely critical. Seeing how much comes from stable fees versus volatile market activity tells you a lot about a bank's overall risk profile and its resilience.
Okay, so we got a handle on how they make money.
Yeah.
Now, how do we actually figure out if a bank is, fundamentally healthy? Our sources point to a specialized toolkit, ratios quite different from what you'd use for, say, Apple or Google.
Precisely. You need a bank-specific lens. We generally focus on four key areas. profitability and efficiency, asset quality and risk management, liquidity and funding, and finally, capital adequacy. Together, these paint the picture of true financial health.
Right. Where do we start? Profitability.
Let's start there. First up is return on assets, ROA. That's simply net income divided by average total assets. It answers the question. For every dollar of assets, how much profit is this bank actually generating?
And what's a good number?
Generally, over 1.0% is considered acceptable. Over 1.5%, that's strong performance. For context, the aggregate for U.S. banks was about 1.16% in Q1 2025.
Okay. And then there's return on equity, ROE.
Yes, return on equity, ROE, net income divided by average shareholders' equity. This one is really the bottom line for shareholders. What return are they getting on their investment? Post-Basel III regulations, typical ROE for U.S. banks has been in the, say, 5% to 12% range, though it did bounce back higher temporarily.
Now, this is interesting. Our sources link ROA and ROE, kind of like a DuPont analysis, but for banks.
Yeah.
Saying a high ROE isn't always great. It could just mean the bank's using a ton of leverage, not actually being super profitable.
Exactly. That's a crucial insight. High leverage can juice ROE, but it also increases risk. You need to look deeper. That also brings us to the efficiency ratio.
Right, the efficiency ratio. That's costs versus revenue.
Basically, yes. It's non-interest expense divided by the sum of net interest income and non-interest income. It measures operational cost control. And here, lower is better.
Lower is better. Okay.
Under 50% is often seen as optimal. It means the bank is spending 50 cents or less to generate each dollar of revenue. Very direct measure of discipline.
Makes sense.
Yeah.
Now, beyond profits, the loan book, that's the biggest asset, but also the biggest risk, right? Assessing loan quality must be vital.
Paramount. Absolutely paramount. We look closely at non-performing loans, or NPLs. These are loans typically 90 days or more overdue.
Oh.
Yeah. The NPL ratio, that's total NPLs divided by total gross loans, is a key indicator. If that ratio is high or worse, rising quickly, that's a major red flag for deteriorating credit quality. Generally, under 2% is seen as better.
And banks prepare for this.
They have to. They set aside loan loss provisions, LLPs. These are funds earmarked for expected bad loans, and they're charged against the bank's current earnings.
Okay, so they're planning for some loans to go bad.
Right. And we can measure how well they've prepared with the provision coverage ratio. That's the total amount set aside in provisions divided by the gross NPLs. It shows if they've socked away enough to cover the problem loans. Over 70% coverage is generally considered a pretty safe level.
Got it. Okay, what about liquidity? Their ability to meet immediate needs, like depositors wanting their money back.
Crucial pillar. That brings us to liquidity and funding stability. One measure is the loan-to-deposit ratio, or LDR, total loans divided by total deposits.
What does that tell us?
It gives you a sense of their funding strategy. A really high LDR, say over 90%, might suggest the bank relies heavily on funding sources that could be less stable than core deposits, like borrowing from other banks. A very low LDR, on the other hand, might mean they aren't lending out enough of their deposits effectively.
So a sweet spot somewhere in the middle.
Often around 80–90% is considered a reasonable range, but it depends on the bank's model. And this leads to a really interesting point our sources make. Not all deposits are equal.
How so?
We look at the CASA ratio. That's current accounts and savings accounts deposits as a percentage of total deposits. CASA deposits are gold for banks because they pay very little or even zero interest.
Yeah, the cheapest funding source.
Exactly. So a higher CASA ratio, maybe above 40%, signals a stable, really low-cost funding base. And that directly helps support a stronger net interest margin, the NIM we talked about earlier.
Okay, that makes sense. So profitability, asset quality, liquidity, what's the last pillar?
Capital adequacy. This is the bedrock, the ultimate safety net. It's the buffer that allows a bank to absorb unexpected losses. Think back to the 2008 crisis. Capital adequacy became hugely important after that.
Right. How's it measured?
The main focus is on Common Equity Tier 1 capital, or CET1. That's the highest quality, most loss-absorbing type of capital, basically, shareholder equity and retained earnings. We measure it with the CET1 ratio. That's CET1 capital divided by risk-weighted assets, or RWAs.
Risk-weighted assets.
Yeah, not all assets carry the same risk. A government bond is less risky than a construction loan, for example, so assets are weighted by their perceived risk. The minimum CET1 ratio required by regulators like Basel III is around 4.5%, but in practice, especially for big banks, the effective minimums are much higher, often over 10%, because of various extra buffers and stress tests.
Wow. Okay, so what's really hitting me here is how interconnected all this is. These ratios aren't just standalone numbers. Our sources talk about a causal chain. Can you walk us through an example? Show that ripple effect.
Absolutely. This is where it gets really insightful. Imagine a bank decides, we need to grow, let's aggressively expand our loan portfolio. Okay, step one.
Right, more loans.
That immediately pushes up their loan-to-deposit ratio. Now, the question is, how are they funding that growth? If they have to rely on expensive wholesale borrowing, not cheap CASA deposits.
Their net interest margin gets squeezed.
Exactly. Then, those new loans they just made, that creates future risk. Some might eventually become non-performing loans, NPLs, which means higher loan loss provisions down the line.
Which eats into future profits, ROA and ROE.
Precisely. And finally, growing the loan book means more assets, specifically more risk-weighted assets, which, all else being equal, pushes down their CET1 capital ratio.
Wow, so one strategic decision ripples through everything. LDR, NIM, NPLs, LLPs, ROA, ROE, CET1. It's all connected.
It's a complete loop, and it shows why you can't just look at one metric in isolation. You have to understand the whole dynamic system to really grasp a bank's health and strategy.
Okay, so we get how they make money. We have the tools to check their health. But for you, the listener, a big question is, how do you actually value a bank? Put a price tag on it. Our sources are pretty clear that the usual methods, like discounted cash flow, DCF, they don't really work well for banks. Why is that?
That's a really critical point. The reason DCF struggles is fundamental. For a bank, debt isn't just how they finance things. Debt, deposits, borrowing that is their raw material. It's the core of the business. So concepts like free cash flow to the firm just don't translate meaningfully.
So what do we use instead?
We lean heavily on relative valuation. Specifically, the premier multiples for banks are the price-to-book ratio, PB, and often preferred, the price-to-tangible book value ratio, PTBV.
Price to book. Why book value?
Because a bank's assets are mostly financial instruments, loans, securities, and they're generally marked to market, or close to it pretty regularly. So book value tends to be a more relevant measure of underlying value than for, say, a manufacturing company with factories and equipment. PTBV is just a stricter version. It strips out intangible assets like goodwill, which can arise from acquisitions.
Got it. More conservative.
Yeah.
Now, this next bit our sources highlighted feels really powerful. There is apparently a direct, logical link between a bank's profitability and its PB multiple.
Yes, this is fundamentally important for valuation. Think about it. If a bank's return on equity, ROE, its profitability for shareholders is higher than its cost of equity, what shareholders demand as a return.
It's creating value.
It's creating value, and its PB ratio should trade above 1.0. If its ROE just equals its cost of equity, it's earning its keep, PB should be around 1.0. But if its ROE is less than its cost of equity,
It's actually destroying value.
destroying shareholder value even if it's profitable in accounting terms, and its PB ratio should logically be below 1.0.
So a low PB doesn't automatically mean cheap bargain, and a high PB isn't necessarily expensive.
Exactly. It's all relative to the bank's ability to generate returns above its cost of capital. This leads to a useful tool some analysts use, a valuation matrix, where you plot PB against ROE for a group of comparable banks. It helps visually identify banks that might be mispriced relative to their actual performance.
Are there other valuation methods besides multiples?
There are. For stable dividend-paying banks, the dividend discount model, DDM, can be useful. But arguably the most theoretically sound approach, and one that's very practical, is the residual income model.
Residual.
Yeah, it basically calculates the value based on the book value plus the present value of expected future residual income, which is defined as earnings above the charge for the cost of equity capital. It measures true economic profit and nicely anchors the valuation to the bank's relatively stable book value.
Okay, interesting. Let's zoom out now. Who are the big players dominating this banking world?
Our sources show it's pretty concentrated, especially in the U.S. Very concentrated. In the U.S., you really have the big four: JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. And the scale is just immense. Get this. In early 2025, JP Morgan Chase's market cap was nearly as big as the other three combined.
Wow, that's dominance.
It really is. Beyond them, you have major investment banks like Goldman Sachs and Morgan Stanley, and then large super-regional banks like U.S. Bancorp and PNC Financial.
And globally, does the picture change?
It shifts quite a bit, actually. While U.S. banks, especially JP Morgan, lead strongly by market capitalization, if you measure by total assets, Chinese banks dominate the global league tables.
Like who?
The Industrial and Commercial Bank of China, ICBC, is consistently ranked as the world's largest bank. By assets, we're talking over $6 trillion. Several other huge Chinese banks are right up there too, alongside major European players like HSBC. So different ways to measure size give you different leaders.
Right. It's easy to just think banks when we say finance, but the sources remind us it's a much bigger ecosystem, isn't it? There's insurance, asset management, payments, and this whole wave of fintech.
Absolutely. The broader financial sector is vast. You've got asset management giants like BlackRock and Vanguard managing literally trillions of dollars. Payment networks like Visa and MasterCard. Huge insurers like United Health Group, even though they're health insurance. And then this explosion of digital-first players, the neobanks like Chime or Nubank.
And things are blurring between these categories.
That's the huge trend. Convergence, the old, neat silos, banking here, payments there, asset management over there, they're breaking down fast. And technology is the main driver.
How so?
Well, look at Visa and MasterCard. Their market caps rival or even exceed most traditional banks. Why? Because the market recognizes the immense value in controlling the networks, the rails that commerce runs on. Then you have tech giants like Apple pushing into finance with things like the Apple Card. And those neobanks are directly challenging the incumbents, often with better tech, slicker user experiences, and lower fees. And it's all part of this bigger shift towards embedded finance.
Embedded finance.
Yeah, the idea of weaving financial services, payments, lending, maybe even insurance directly into non-financial platforms or apps. Think about paying directly within a social media app or getting purchase financing right on an e-commerce site. It brings the financial service to the customer where they are instead of the customer having to go to the bank.
That feels like a fundamental shift. So for you, the listener, trying to stay informed or maybe even invest here, you can't just focus on the old school banks anymore.
I think that's exactly right. A truly robust strategy for understanding or investing in the financial sector has to look beyond just the traditional deposit-taking banks. The long-term winners might not be the ones holding the most deposits, but maybe the platforms controlling the data, the networks, the customer interfaces.
Fascinating. Okay, let's bring it back to the near term. What's the economic crystal ball showing for banks in 2025?
Well, the consensus view from our sources seems to be pointing towards a soft landing for the U.S. economy. So, not a recession, but slower growth. Think moderate GDP growth, maybe 1.7% to 1.9%. The labor market staying relatively stable, maybe unemployment around 4.2%, and inflation continuing to cool off, heading back towards the Fed's 2% target.
And the Fed itself, interest rates.
Crucially, the expectation is that the Federal Reserve will likely continue cutting the federal funds rate through 2025, maybe into 2026, gradually moving policy back towards a more neutral stance after the hikes of previous years.
Okay, so a soft landing, falling rates. How does that combo typically hit the banks? What are the key things to watch?
Well, this sets up an important dynamic for banks in 2025. The main challenge will likely be that net interest margin compression we talked about. As market rates fall, the yields on their assets will likely drop. But a big chunk of their deposits might already be paying near zero, so they can't cut those costs much further. NIMs could get squeezed.
But there are offsets.
Yes, potentially significant ones. Lower rates should stimulate loan demand. Borrowing becomes cheaper for businesses and consumers. And importantly, lower rates make it easier for existing borrowers to manage their debts, which should keep credit quality strong and loan loss provisions manageable. So, it's a mixed bag.
And which banks might handle this better?
Banks with those strong, diverse, non-interest income streams we discussed earlier, they'll be much better positioned to offset any pressure on their net interest income. Their earnings will be less sensitive to the rate cycle.
Okay, so wrapping this all up. For you, the learner, navigating this complex world of banks and finance, what are the key takeaways, the things to really focus on?
I'd boil it down to maybe 4 main points. First, really try to identify banks with resilient business models. Look for those less reliant on just net interest income, banks with strong, stable sources of non-interest revenue.
Okay, resilience through diversification.
Second, scrutinize efficiency and funding. Banks with low efficiency ratios, meaning tight cost control, and high cost ratios, that cheap, stable deposit base, they have built-in advantages that protect the bottom line, especially when margins are pressured.
Efficiency and cheap funding. Got it.
Third, apply that rigorous valuation discipline we talked about. Use the ROE versus PB framework. Don't just chase a low PB multiple. Make sure the bank can actually sustain a healthy return on equity, one that's above its cost of equity. Is it actually creating value?
Value creation, not just low price. Makes sense.
And finally, number 4. Adopt that broader, long-term perspective. Recognize that convergence of finance and technology is real and ongoing. A truly comprehensive view, whether for understanding or investing, has to extend beyond just the traditional banks. Include the dominant payment networks, the data processors, maybe promising fintech leaders. Build a diversified, resilient picture of the whole evolving ecosystem.
Wow, what a journey. We've gone from the nuts and bolts of how a bank makes a dollar, through analyzing its health with this specialized toolkit, valuing it with specific models, and now looking at the whole competitive scene and the 2025 outlook.
Yeah.
That was definitely a deep dive.
It really covers a lot of ground. And maybe a final thought to leave you with. Looking ahead, the future of finance might be less about who holds the most physical assets or deposits, and more about which platforms, which institutions best control the flow of data, the networks, and ultimately that crucial customer interface.
Hmm,
It really challenges us to think about what banking even means in the next decade.
a really provocative thought to end on. Definitely something to chew on. Keep those insights coming, everyone, and we'll see you on the next deep dive.